Today we're shooting a segment on my 2023 Q1 in review to talk about the banking sector and the collapse of Silicon Valley Bank and how it has affected not just the banking system and consumer confidence in the banking sector here in the US, but also across the globe. So I hope that you tune in and take a look. Hi everyone. The last couple of weeks have definitely added some elements and layers to the financial and real estate markets that many people, I would say most people, really did not see coming. And that, of course, is the demise and the closing of Silicon Valley Bank, which has been the preeminent bank for startup companies here in Silicon Valley. They've had the lion's share of the business. They were highly regarded. And let's just say that, the fact that they have failed is saddening for many people and frankly probably puts a little bit of a black eye on Silicon Valley. I'm Brian Chancellor of Christie's International Real Estate Sereno. I have a BA in economics from UC San Diego, class of '92. And the reason that we're going to be talking about these things is to really also ultimately understand and talk about how it may affect the local market. But by no means am I here to say that I am a financial advisor or an expert. There are people who do this every single day, and even with the accessibility that I have to people and information, it's fair to say that this may be a simplification of all that had transpired. And again, this is nothing that anybody would have liked to have foreseen. Along the lines of Silicon Valley Bank, and ultimately what happened is that they had tremendous success, as I have said, and their deposits were probably approximately about $49 billion back in 2018. And if my memory serves me well, between 2018 and 2020, their deposits then went in excess of $100 billion, I think in the neighborhood of about $108 billion. Then the year 2021 came, and their deposits by the end of 2021 were a whopping $189.2 billion. So they almost doubled in that year alone. Startup companies and venture capitalists and the clientele that they had were making oodles of money, clearly. And so those deposits were foreseen. And ultimately, what did SVB need to do? They needed to figure out how to make money from their assets, coupled and to try to insure themselves against what their liabilities, being their deposits, would be. And the bet that they made was investing into bonds. Bonds at that point in time were probably about 1.7 some odd, 1.73 I think is the number, percent, versus some other financial mechanisms that were available. And it was a bet that came to bite them in the derriere. The fact is that they put too much money into bonds for too long, and interest rates went up very quickly, much more than one would have anticipated. It's fair to say and to ask, well, why did they invest them for so long? Many people would say investing in bonds is a very conservative investment and wouldn't criticize that. Well, but when the interest rates went up as quickly as they did, they then were not making as much money on their assets, and the bonds were worth less money at face value than they had been as the interest rates went up, too much. And so that even to be competitive, what they had to pay out to their depositors, being the clients of the bank, was too much. Silicon Valley Bank's business model is B2B, business to business. They've been talked about in the same conversation as First Republic Bank, whose corporate headquarters are in San Francisco, and they are very integral to our local micro market of real estate. They are in also some of the high net worth zip codes, shall we say, or cities and towns throughout the United States, and they cater to a very stable and wealthy clientele, so to speak. Silicon Valley Bank's demise has ultimately adversely affected First Republic Bank, and I think unfairly. Silicon Valley Bank's business model of B2B and how they cater to and really understood better than anybody else what the startup companies needed, versus First Republic Bank that is admittedly very conservative in their approach. For example, they don't have any exposure to cryptocurrency. The requirements that they have of their clients when it comes to home loans or mortgages is very stringent. They very much encourage a banking relationship. So there are many times of what some people would call a back-to-back, where there are deposits that are coming into the bank to continue or to enhance a relationship in order to get the most attractive rates that First Republic has at that time. And they have a very, very small fraction of 1% of default on an annual basis of their mortgages. year in and year out. And year in and year out, they've been rated one of the highest rated banks in the country, typically in the top 5, I would say, and many times, if not most of the time, in the top 3. But because they are a mid-sized regional boutique, and probably because many people had relationships at both of these banks, they had a target on their back, or they became the gossip on the street, so to speak, of, oh, I hear First Republic is next. And I heard that from many, many people. Their chief investment officer is somebody whose luncheon I go to every year. Back in November, he said that the Fed is trying to do at least one of the following 3 things in order to get inflation in check because it's so stubborn. That being, get wages to stop continuing to go up, to slow down the real estate market, and to break a bank. And when he said that, I was like, break a bank? Seriously? But let's fast forward. The fact that that has happened, it probably wasn't the bank that may have been intended, because SVB is so integral, not just here to Silicon Valley, but globally. The fact that he anticipated that gives me great confidence of the leadership at that bank. Yes, I do bank at First Republic Bank, in disclaimer, but when he understands that was what's happening, of course, strategically, they would have been positioning their bank and their liabilities and assets accordingly. This contagion, of course, has gone across the pond as well. Not just Signature Bank in New York, who had significant cryptocurrency, exposure, but obviously we know about Credit Suisse, and as of today, we know about Deutsche Bank. But European banks also in their monetary policy have handled things very differently than many of the banks within the US. Overall, what we're talking about is confidence in the banking system here and in Europe and in other parts of the world. That's really what it comes down to. There are banks that take more risk and may have some issues coming up, but there are other banks that don't have these issues or concerns whatsoever. I talked to a friend who's very high up with a regional bank in California, and he said, and he was not criticizing Silicon Valley Bank at all, very much respected Silicon Valley Bank, had very deep-rooted relationships at Silicon Valley Bank, but said, hey, my team and I had these same conversations as to what to do with our surplus of deposits, and they decided not to put them into bonds for such a long period of time, specifically because they did anticipate having those interest rates go up. When you talk about Europe, some of those banks may have other vulnerabilities because they kept their interest rates even lower than banks did in the United States. The US was criticized for that for quite some time, but ultimately it's about the long run. How does all of this and the sentiment or the lack of confidence or the challenge to consumer confidence in the banking affect our local micro real estate market? Nobody can tell you that it won't have some effect. Of course, there are going to be some buyers who say, hey, I'm not comfortable. I'm going to sit on the sidelines. Or maybe they're going to be less assertive when it comes to making an offer on a property that they are interested in. There will also be some sellers who say, hey, I'm not going to put my house on the market, right now because I don't have to sell. But the saving grace and the reality is that no matter what has happened in our market, whether it was the Great Recession, whether it was the pandemic, or whether it is even now, our inventory levels remain low, and people are year in and year out surprised, and they expect for them to go higher, but the bottom has just not dropped out of the market. That's not to say that there aren't some fluctuations in value. Of course, here in this area, and even in Palo Alto, that we're insulated, but we are not immune from fluctuations, but they tend to be more shallow and more short-lived. Even in this last week, there are more buyers that are entering the market. I'm not saying just with my business, but I've talked to many, many agents and on Zoom calls, in Google Meets, and networking groups. I don't have any example of a buyer saying that they wanted to rescind their offer even in a non-contingent transaction to get out, which is something that happened at the beginning of the pandemic, which was quite common at that point in time. There are people perhaps putting contingencies together to say, hey, if in fact we have an issue with the lender, that they will get their deposit back if they can't get other financing. But we are very, very fortunate here in this micro market. Because of the low inventory, we do not have any more land, and people are pretty astute when it comes to their finances and the opportunities that are in front of them. Thanks for taking the time. Brian Chancellor, Christie's International Real Estate Sereno in Palo Alto.